we're going to figure out why U.S. tariffs are pressuring Canada's dollar. In late July, Reuters reported that speculators had roughly $12.5 billion US dollars in net bearish positions against the Canadian dollar. That's a bet that the Canadian dollar could fall. But that number is not really the story. It's a signal that markets are looking at Canada's economy and asking a much bigger question. What happens when a country depends heavily on one customer, one currency, and one political relationship, and that relationship becomes unpredictable? The deeper story is that Canada sends an unusually large share of its goods into one market, the United States. When access to that market becomes uncertain, Canadian companies have to rethink prices, investment, hiring, and supply chains. And the Canadian dollar becomes one place where that risk gets priced. So this is not just a story about a currency chart. It's about tariffs, trade dependence, and who absorbs the cost when the rules of the largest trade relationship in Canada's economy suddenly change. So what does it mean to short the loonie? Why are traders doing it now? And is this really a bet against Canada's dollar? Or is it a bet against the economic system underneath it? First, most shorted currency needs some translation. A short position is simply a bet that an asset will fall in value. In this case, traders use currency futures to bet that one Canadian dollar will buy fewer US dollars later than it does today. If the loonie falls, that trade can make money. If it rises, the trade becomes a loss. That does not mean the traders are predicting Canada disappears. They are not literally attacking the country, and they are not guaranteed to be right. But when a short position gets this large, it tells us something very important. A lot of money sees more downside risk in the Canadian dollar than upside, at least for now. Markets do not need certainty to make that bet. They only need to believe that the risks facing Canadian businesses and policymakers are becoming harder to manage. So what risk are they pricing in? One major risk is tariffs. The United States is scheduled to impose an additional 50% tariff on certain Canadian goods on August 19th, 2026. The measures cover nearly $20 billion US dollars in annual imports from Canada. The exact scope matters. This is not automatically a tariff on everything Canada sells to the United States. The new duties apply to specific goods, including products such as dairy, alcohol, hockey equipment, cement, and a wide range of other items. But not everything does not mean not serious. Tariffs do more than raise the price of products listed in a policy document. They change corporate behavior before the tariff even arrives. A U.S. buyer may delay an order. A Canadian supplier may postpone buying equipment. An executive may freeze a factory expansion because the numbers no longer make sense. A company that expected stable access to U.S. markets may suddenly have to rethink its prices, inventory, supply contracts, and its future investment. And that is the real issue. The question is not only whether a tariff exists, it is who has the power to impose it, who can absorb it, and who carries the cost when the rules change. Imagine a Canadian company selling into the United States. A new tariff makes its product more expensive for the American customer. That company now has several bad options. It can raise its price and risk losing sales. It can cut its own price and accept lower margins. It can pressure suppliers to reduce costs or delay hiring or investment. It can shift some production, or it can wait freezing decisions until trade rules become clearer. That is how a tariff turns a corporate decision chain. The cost does not always land in one place. It can hit several shareholders through lower profits. It can hit suppliers through tougher contract terms. It can hit workers through slower hiring, less overtime, or canceled expansion. Or it can hit customers through higher prices. Companies with larger margins, more pricing power, and more cash for production already inside the United States might be better positioned to absorb that uncertainty than the smaller Canadian suppliers dependent on cross-border demand. That doesn't mean every large company benefits. It means unequal capacity to absorb uncertainty can determine who keeps investing and who loses contracts and who gets forced to pass costs on. So when markets price tariff risk into the Canadian dollar, they're not only looking at one policy announcement. They're looking at how exposed Canadian businesses are when their most important market becomes less dependable. That's the structural issue. The United States is not just another Canadian trading partner. It's the dominant destination for Canadian goods exports. The relationship has created enormous economic benefits, but it also creates concentration risk. When one market accounts for so much demand, access to that market becomes more than just a business opportunity. It becomes a strategic vulnerability. A policy decision made outside Canada can affect Canadian order books, investment plans, employment decisions, and demand for Canadian dollars. And markets do not wait for the final damage report. They price the possibility early. That's what the short position might be reflecting. Not the idea that Canada suddenly stops functioning, but the risk that a highly connected economy has less room to maneuver when its central trade relationship becomes unstable. A weaker Canadian dollar makes that problem more complicated. For some exporters, a lower loonie can help. If a company earns revenue in US dollars, those dollars convert into more Canadian dollars. Canada can also become cheaper for foreign visitors and foreign buyers, but those benefits have limits. If an exporter is facing tariffs, weaker demand, or higher costs for imported goods and machinery, a lower currency does not solve the underlying problem. Many Canadian businesses buy goods priced in US dollars. Machinery, industrial equipment, auto parts. When a Canadian dollar falls, those costs become more expensive in Canadian dollar terms. Then management has another decision. Absorb the cost, cut somewhere else, delay investment, or raise prices. That's how an exchange rate story can become an affordability story. Not instantly, not for every product, and not exactly the same way at every company. Businesses can hedge. Contracts can delay the impact. Competition can limit price increases. But eventually, a cost has to go somewhere. And that is the question that matters most for households. Not simply, will the dollar fall? But if trade uncertainty raises costs, who pays? Workers? The suppliers? What about the shareholders or businesses? Or consumers standing at the checkout counter? For Canadians already watching grocery bills, car payments, rent, and mortgage renewals, currency weakness can become another layer of pressure. The effect may arrive gradually, but it can still be real. The Canadian dollar is not just a financial asset. It's one place where trade policy, corporate planning, and consumer costs meet. There is one more complication. People often assume that if tariffs slow the economy, the Bank of Canada will simply cut interest rates. And if rates fall, loonie falls further. That can happen, but it isn't automatic. Tariffs can hurt growth by reducing trade and investment. They can also raise prices by making goods and business inputs more expensive. That gives the Bank of Canada a difficult choice. Support a weaker economy or avoid adding more inflation pressure. The Canadian dollar reacts to all of it: trade, inflation, growth, oil prices, interest rate differences, and the US dollar itself. That's why the short position is a warning signal, not a forecast carved in stone. There are several ways the short sellers could be wrong. A deal could remove the immediate tariff risk. The final policy could be narrower than feared. Canadian exports could hold up better than expected. Commodity prices could rise, the US dollar could weaken, or companies could adapt faster than markets expect. There is also the possibility of a short squeeze. If too many traders make the same bearish bet, good news can force them to reverse it. If the Canadian dollar starts rising, traders who shorted it might have to buy Canada dollars close to their position. So that buying can push the currency higher. So the same short position that makes the headline look frightening can also create the conditions for a fast reversal. So in Reuters' late July comparison, was the Canadian dollar the most heavily shorted major currency? Yes. It was the highest net short among the currencies traded on the Chicago Mercantile Exchange in that report. And tariff uncertainty was one major risk markets were weighing, alongside growth, interest rate differences, commodity prices, and the broader US dollar. But the deeper bet is not that Canada is finished. It's that Canada becomes more vulnerable when its most important trade relationship becomes less predictable. The tariff is the visible event. The larger issue is the system behind it. An economy tied to one dominant market, one dominant currency, and one political relationship outside its control. The real question is not just whether the loonie recovers. It's whether Canada can reduce the economic risk created when one external policy decision can reshape corporate investment, supplier contracts, jobs, and consumer prices across the country. The short position is not a prophecy. It's the market's current price for uncertainty.